for letting me know that, Anne. All right, so today we're going to be talking about protecting your assets. So a lot of people are investing in homes, not only for their primary residence, but also as an investment property. So you have an Airbnb and you have a rental home and you have all of these assets that are in your name or in your LLC's name or under your trust, and they're protected. I mean, you pay for them, right? Either you live on them or they are your vacation homes or you rent them short term or long term. So real estate is a real great opportunity, especially right now with the economy, to be able to put your money in and be able to let it grow. And it's a great investment. But somebody has to pay the mortgage, right? Somebody has to pay for that mortgage. And when you have a mortgage or 2 or 3 or 10 under your name, you are responsible to make those payments. If you make the payments, you keep the asset. If you don't make the payments, you lose the asset. And so, a good portion of the people that have their investments made, some people are living inside your investments, which means you're getting cash flow from that investment, then you're making money. So somebody is paying for your mortgage, right? So let's say I have my primary residence, I pay for my mortgage, but then I have rental properties. My tenants are paying for my mortgage, correct? Except that sometimes it happens that people lose their jobs or people want to move out, go find another place to live. And so that asset is now your expense. Hi, Jenny. How are you? Good to see you.
Hi, how are you?
Okay, so what happens is you are responsible to pay for the second and third and fourth mortgage and whatever else is attached to that, to your name. So if you have either a slush fund that you can take care of that mortgage, or you can put another tenant in there, you're good to go. But what if you can't? What if you are not able to fulfill that specific expense and then now it becomes your expense? How many months can you go without making that mortgage payment without losing that asset? Do you have a plan of action for such a time? Now we're talking about assets, we're talking about investment properties, right? So if you have an investment property and you have a tenant there and they're paying the rent, this is wonderful. But if they're not paying the rent, you must have enough money set aside for that purpose, or you need to quickly flip that investment where you have another person living in there, or you transfer a long-term to a long-term, short-term, or vice versa. Jenny was just talking about it because she has investment properties. And so she was planning on short-term, and then she quickly turned around and put a long-term in there. Yes, yeah, she's clapping because we just talked about that today, Jenny. And so she was a wise investor that found a way to continue having cash flow in that investment. But what if that doesn't happen? I have clients that live in California that the laws there protect the tenant. So during COVID, they did not receive rent, and the laws did not allow for the landlord to evict the tenant. And so they were not receiving rent. They had to pay a mortgage. And so they're pretty much having to pay 4, 5, 6 mortgages on a very tight income. So if you don't have savings, you lose your asset, right? So we're talking about investment properties. Now let's talk about your personal, your primary residence. There's no asset there, right? That's your primary residence is a liability in your pocketbook. It could be an asset because you can always write that off as a business owner. You can have a home office. So it becomes an asset because you use that as your home office and you have expenses attached to your primary residence. But at the end of the day, the mortgage comes out of your pocket. Nobody's paying for a mortgage, correct? So let's say that the breadwinner of that primary residence is injured, has a critical injury, a chronic injury, has been diagnosed with a terminal illness, passes away. What happens to that household when the primary breadwinner of that household can no longer pay for the mortgage? How many months can your household go on without paying for that mortgage, without losing that home? Do you have a slush fund? Do you have another way to replace that income in order for you to pay for the mortgage? So this is the conversation that we want to have today, because there's a lot of people investing in real estate right now. This is a good time for buyers. People are purchasing homes cash, or although there's a lot of fear of the high interest rates, this is an awesome time to buy homes, because home prices are going down, which means you purchase it right now and you refinance later. That's what I've been telling all my clients. Yes, the rates are high, but in 2 years, I believe next year, election year, the rates will go down, because that's how politicians get into get back into politics, right? They go to re-election by saying that we're going to lower your taxes, lower your rates. So they're going to push for that lower rate, so everybody is happy about buying homes at lower rates, and then they get voted into office again. So next year, election year, and if you watch every 4 years, rates go down right about election time. So people are investing in real estate right now. But who's protecting your asset? When you purchase a home, if you look through your detailed information, there are various types of insurance. So you're paying title insurance, which means that through the history of ownership of that asset, there are no liens, there are no cases, there are no judgments against that property. So when you take possession of that property, when you take the deed and the title, there's no mess ups with that. That's what the title company does, or your lawyer does. Make sure that there's no history of any problems with the title of that property. So that's title insurance. Let's say that you take title of the home, and then they find out that 40 years ago, the owner owed the construction company some money, and now you're liable for it because now the asset is yours. Title insurance takes care of that issue. So you have that, and you get that through your title company at closing. And we're not talking about that, okay? And then you have homeowners insurance. Let's say that you have a fire or a flood, or a tree falls on top of your house, or a neighbor drives inside of your house. You have homeowners insurance that's going to protect you in case of damage, in case of something, a wall falls down, whatever. Then you have a claim towards that kind of insurance to protect the dwelling. It protects the dwelling, the people inside, and your possessions that are inside. So that's homeowners insurance. Some people have appliance insurance. So if I have that on all my rentals and in my property here, which covers your washer, dryer, all of your appliances, all of your plumbing, and all of your electrical. So if anything happens to those things, I have insurance for that. I just call the man. He comes over for $50. It's my copay, and he fixes whatever. Tomorrow I have somebody come in and take a look at my dishwasher. That's appliance insurance, or homeowners. There's another name for it. It's not called appliance insurance, it's something else, but you have that insurance. But how about mortgage insurance? Insurance to protect your asset in case you cannot pay your mortgage. It's a 30-year commitment or 15-year commitment, whatever your loan is. And within those 30 years or those 15 years, you must make a payment every month. If you skip 2 payments, the bank is going to send you a pre-foreclosure letter, and then you're going to lose your assets. So if you are the breadwinner, or if you live with the breadwinner, or you have multiple assets where all it could happen to break loose is your tenant decide that they cannot pay rent anymore, and then you're responsible for multiple mortgages, this is the talk you want to have today. So, and nobody, it's a rare product to find in the market, because mortgage protection is something that as a homeowner, you want to seek that type of protection. It's not really offered to you unless it's the week of your closing, and all of a sudden you receive a bunch of papers in your mailbox and says, you're supposed to do this, you're supposed to do this. If you don't take action right away, they stop coming because they assume that you don't want that. And people that offer you this type of product stop sending them to you. So if you've been in your house for longer than 6 months, you're not receiving it anymore. You're not receiving offers for mortgage protection, which means now you have to think about it, and you have to go seek out somebody that can cover your asset. So beyond your personal assets, if you have other assets, this is what we want to talk about. So let's scenario, okay? Scenario number one. Homeowner, breadwinner passes away. So now you have your home and or your car, your boat, your RV, your land, or whatever it is that you're making payments towards. All of those assets, if they have a loan on them, they can be lost at the loss of life. So if the breadwinner loses their life and they cannot pay those assets, they're all going to be confiscated if you don't make the payments. Okay. And if hopefully you'll have a life insurance policy on this person, but if you don't have life insurance policy on this person, you're not collecting anything. That means that the income is stopping to come into the household, which means you have to find another way to make that money to make those payments. Let's say this person does not die, but they have an accident where they're unable to work, make a living, and they stay 60, 90 days without working. They don't make a living, but they're going to go back to work eventually. All it takes is 2 missed payments on the mortgage for you to receive a pre-foreclosure letter, which means if you are hurt, you have to have an operation, you're going to be out of work for 90 days. You are on pre-foreclosure status, right? Unless somebody's making mortgage payments for you, unless you're putting a GoFundMe on your family group, right? I laugh, but that's exactly what happens. I see that all the time. People put GoFundMe requests on social media because they're like, oh, I broke my leg. I can't work for 3 months. I can't pay my bills. Help my family out. Okay. So, people do what they have to do, but wouldn't it be awesome to be able to know that you are covered 100% if anything like that would happen on critical condition or chronic illness. Many of you know a friend or some family member that has been diagnosed with a chronic disease or a debilitating disease, cancers, types of cancer, heart attacks, anything that will keep you away from performing 2 of the 6 vital activities of living. So there's 6 activities of vital living that you by yourself are supposed to be able to 6 daily activities for living. So there's 6 activities that every human being should be able to accomplish on their own. If you cannot do 2 of those, you are considered incapacitated. That means that you are able to have some type of a help. So the first one is eating. If you cannot literally eat by yourself, if you cannot get fork to mouth and eat by yourself, that's one activity of daily living that you should be able to accomplish on your own. Bathing and hygiene. So can you take a shower by yourself? Can you brush your teeth by yourself? Can you brush your hair by yourself? Things like that, okay? So bathing and hygiene is the second one. Dressing. Can you put on your clothes by yourself? Your pants, your zipper, your buttons, your shirt, socks, shoes. Can you dress yourself? Eating, bathing and hygiene, dressing, grooming. Can you cut your fingernails? Can you, again, brush your teeth? Can you brush your hair? Also grooming and mobility. Are you able to get up from a chair or from a bed or from a couch, from the floor by yourself, or do you need help? Mobility. And then toiletry. Can you use the toilet? Can you go to the bathroom and wipe yourself? Those are the 6 daily activities that somebody should be able to accomplish by themselves. If you are unable for any kind of diagnosis, complete 2 of those on your own for 90 days or more, then you could be covered by such thing as a mortgage protection plan. Okay, so 2 of these 6 activities for more than 90 days, then you can be covered by a mortgage protection plan. So even if you're going to go back, if you're going to have therapy and go back to work and be able to earn a living later, you will be able to collect the amount of your mortgage, the full amount of your household, not the one payment, but the full amount. pay off your mortgage, and then whatever's left over, because if you've done it, if you've paid 5, 10 years of mortgage, now you have a leftover amount, right? The coverage stays for the amount that originally you purchased the house for. Now you have leftover money. Then you can take care of nurses and home health care and meals and whatever else you need. Okay. So far so good. Does everybody understand what I'm saying so far? Do you have any questions? Want to put it on the chat? If you are watching this video on YouTube later and you have questions, please put it on the comments, because I would like to be able to answer these questions as they pop. I have a notification that comes in on my phone. So even if you put a question there 100 years later, I'll still get it. Let me log in over here to the profile to show you what this looks like on print, because I want to share my screen to show you what that looks like. So let's do numbers for a little bit. Let's pretend that you have a 30-year mortgage that you just got this year, and the house is $500,000. Okay. So I'm going to put it over here in the calculator, $500,000. And let's say that you have a $30,000 car. And let's say that, what else people have money that are assets that if you don't pay, you lose. We're not talking credit cards, because that, I hope that you get to lose that. But a car and a house. What do you think?
Boat, jet skis.
So what do those things cost? What does a boat and a jet ski would cost? Like 10,000? I don't know. I've never priced one.
I think it's higher than that. I think it's around 50 or 60, depending on what you're trying to.
Okay. So we're gonna let's put another 50,000. So right now it's 530,000. Let's put 70,000 to make a roundabout number. Okay. So let's say that you have an RV and you have a boat and you have one of those little bikes that you run on a dirt bike, whatever. 600,000 in assets that if you don't pay for, they'll come and confiscate that for you. So far, so good. Okay, so now I am going to share my screen in order for us to kind of play around with these numbers. Okay, share screen. So where is the thing? Here it is. So what we're gonna do is we're gonna talk about let's pretend as the person lives here in Florida, okay? And we're gonna talk about a mortgage, or let's say asset protection. And this has to do with the age of the person, and if they are a girl or a guy. Those are the only two genders that we offer in our program. So you get to pick one, and the one that you are, because they're going to check to see what you are through blood test. And then let's say that is a 45-year-old person. Okay, so a 45-year-old person. And now we're going to do it for $600,000, because that's what we talked about, right? The house and the boat and the car and blah, blah, blah. And we're going to do it for 30 years because they still have 30 years on their mortgage. And now we're going to see what it would cost for that person. Did I just lose the share screen? Yeah. Reports right here. So let's say what it would cost to protect all of those assets in case somebody or the breadwinner would pass away. So for $600,000, it would cost $213 to protect all of those assets. If you are a guy, if you're a girl, it's a little bit cheaper. Let's say that if you die tomorrow, your beneficiaries would receive $600,000, and you'd be able to use that as you please. It'd be a $600,000 check. So if you have paid $10,000 off your house already, now you can take the $600,000, pay off $490, and you have the $110 left over. And then you can pay your boat and blah, 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 and you pay off all of your assets. So nobody's coming knocking on your door to take on your assets. So if you have a terminal illness diagnosis, you're going to accelerate that, right? Because that's supposed to be for 30 years, but you're going to receive that earlier. So let's say that you receive a terminal illness diagnosis, you can pick up $511,000. Or you can get on a critical illness would be $468,000, or a critical injury, $468,000. If you have diagnosis of an Alzheimer's diagnosis, you get 400,000, a lump sum. But if you have a chronic illness, you can receive 6,600 a month for those amounts. This is for the amounts that we're just playing with here. Of course, based on your age and based on the amount that you want to protect, there will be different amounts. But in this case, where the person is 45 years old, male, and they're going to protect $600,000 in assets, this is what it would cost them, $213. When you do that, if you die or if you become ill, these are the coverages that you receive. Now, if you have other things happen, if this is, of course, a tax-free benefit. So let's say that your beneficiaries receive that at your passing, they don't have to pay taxes on that money. Or let's say that you are surviving and you just have one of these diagnoses and you cash out that lump sum, you do not pay taxes on that money because this is an insurance. So because it's an insurance, there's no tax on this product. Okay. Now let's say that 20 years passed and you have not used this product. You have not had any claims. God willing, you're not going to ever need this insurance, because then that means you're going to be healthy and you're paying off your mortgage and you're paying everything off and there's no sickness and there's no diagnosis. Then at 20 years, because you're 20 years older, right? So now this person is 65 years old. At 65, it's very, very rare to get good insurance to protect your family. You can then switch this insurance, which was a 30-year product, to what we call permanent insurance, which then starts accruing cash value. It's like a bank that you're going to start putting money in there, and it will be good until you die, so that it does not end at 30 years, but it goes until death. But the benefit of that is that you don't have to have, let's say, a medical exam to find out if you're doing well. So let's say that within those 20 years, nothing happens to you. There's no diagnosis. And you say, okay, I want to switch this to a permanent insurance. I don't want it to end in 10 more years. Then you transfer that into a permanent insurance. And the second year, the third year into the new permanent insurance, you do get a claim. You do receive a diagnosis. You now can continue receiving insurance, because although you are sick, you have transferred that, and you don't have to worry about if you're sick or not at that point, or old, right? Because when you're old, it's much more difficult to get insurance, correct? So at this point, you are able to transfer within the 20 years. You can transfer that to become a permanent product, which at 65 is a very expensive. It's not going to be 213 if you decide to wait until you are 65 to do so. It's going to be a ton more than that, and all of us know that. Okay, so that's what happens when you choose to do that when you're young and when you are healthy, because you can protect your assets and you can have that. So let's talk about for a little bit about how this would transfer into monetary benefit. Let's pretend that you do have a $500,000 house and you take a $500,000 insurance policy. But then in 10 years, your mortgage is now $400,000, right? Because you paid $100,000 into you're making your monthly payments and all. So now in 10 years, you paid $100,000. You now owe $400,000. I'm just going to throw numbers at you. But now you have a claim. You're able to collect $500,000 on there, pay off the remaining $400,000 that you owe in the mortgage. That leaves you with $500 left over, or $100 left over. With the $100,000 that you have left over, you can do whatever you want with it. There's not a specific way that you must spend that money. It's a check, a lump sum check, that it gets written off and sent to your mail, or you can have it direct deposit into your bank. And so it's just they're discretionary. You choose how you want to spend this money. So if you have bills that are accumulating because you lost work, or if you have medical bills that are attached to this claim, you can use that money not only to pay for your asset, but also to take care of the bills that are accumulating because you're not working. So this product is something that's extremely inexpensive. It doesn't require much for you to be approved for, but it is based on the person that is going to be paying. So you want to write this policy protection on the person that is responsible to pay for the mortgage, because once that person is no longer there, you lose the asset. It is an insurance based on an insured. So there must be a person that the insurance is on. It cannot be on the property. It must be on the person that is no longer going to be paying for the asset. Because if the person receives a diagnosis or passes away, that's when the insurance gets paid off. It's not if the house falls down. That's another type of insurance. So it is to protect your asset, because the person that is making the payments for the assets is no longer able to make the payments because of illness or death. That's when you are able to use this insurance. Now, there's so many other, I just showed you one company. There are other companies that offer the same product. Because I am a broker and because the agents that are on our team are brokers, we are able to show you other options. This one is one of the easiest to get approved for. It requires very little on the application process, but there are others that offer you an extra benefit that I really like to tell my clients about. But that one is a little bit more difficult for you to get approved. And I'll just share that information. And if you're watching this video later and you want to have questions about that, ask me, because then we can run an illustration based on your specific case. But this other one that is a little bit more difficult to get approved for and is a little bit more expensive has one extra benefit, and it's what's called the cashback option. So let's say that within the 30 years that you have been insured, you decide that you don't want to transfer this insurance to a permanent insurance. You want to just liquidate that. This normally, the way I showed it to you, is just like a car insurance. You pay for the 6 months or you pay for the year, and if you don't have an accident, you don't use it. You were insured, but you don't get your money back, right? Or you don't get any benefits from it. The one that I just showed you is exactly like that. But the cashback option, it's like a savings account. So at the end of the 15th year, at the end of the 10th year, you can request to get all the money back, but you're going to get 50%. But at year 15 or 20, you don't have to wait until the 30th year. At the year 15 or the year 20, you can get 100% back of what you paid into premiums. So let's say, you know what, I am independently wealthy. I already paid my mortgage. I don't need to protect my mortgage anymore. I paid it off earlier, or I have a bank account, or I'm independently wealthy, or my wife or my husband are working full time now. We don't need protection for this payment. You can get your money back that you put into it. There's no interest attached to that, but at least you're recouping everything that you paid into the premiums, which is an awesome benefit if you are into that kind of benefit. I love that benefit. And although it is a little bit more expensive because it is a savings, I prefer to that because I know I'm getting my money back. So if you are curious to see what it would cost for you to have that extra feature on your product, again, comment below on the comments on YouTube, or send me a message, and then I'll be able to run an illustration that shows your age, the amounts that you want to cover, and what it would cost to have a no cashback or a cashback option, so you can make a decision on that. Any questions that you guys have for me regarding this product? So far, so good. Well explained. Okay, very good. And then one more thing. So we talked about the non-cashback option, the cashback option, but then I want to talk to you one more strategy that I always teach my clients. And it is the strategy of having an emergency fund for you to draw from. So again, we're talking about an insurance where you have a claim. You either passed away or you have a diagnosis of critical or terminal illness or chronic illness. But let's say that none of this happened. Let's say that you broke the one leg and one arm, but you're able to dress yourself, feed yourself. So the doctor's not going to give you that diagnosis where you're hurt, but not hurt enough to claim your benefit, right? Let's say, and this happens, right? I have clients that work in construction, and they use a hammer and they hammer their thumb or they hammer their right hand, but they can do everything. They can feed themselves with the left hand, they can drive, they can dress themselves. So they're injured, they cannot work because they need the right hand to do all their labor. They're not making any income, but they're not injured enough to file a claim with the insurance company. So what do you do then? Then you run a fund, GoFundMe, right? Then you run a GoFundMe. No, it's not a cause for laughing, but I have had that situation where a client will call me and say, I got a bee sting and I cannot move my arms and legs because of my allergy, but I won't be able to work for 2 weeks. So that's not enough. Like I'm only 2 weeks off work, but then I'll go back to work after that. So that's not enough. That's not 90 days or 60 days, which means I still need help financially, right? I still need to find a way to pay bills because I cannot work for 60 days, or I'm sorry, 45 days, 50 days. I'll be able to not work. But then who's going to pay the bills for that month that you're out of work? So that's when you need to have an emergency fund or plan B in protection for you, so you don't go into those situations where all your bills are late, your kids can't do anything they need to do, you're struggling to put food on the table. And those emergency funds are put together with a family bank, with a place where your money is growing, guaranteed, where it's put away, where it's not easy access. Because what happens is when you have easy access to money, you end up using it for emotional purchases or little emergency that all of a sudden you're drawing from that all the time, and then it goes away. So you put some money away, but then something happens and you pull it out from that. That emergency fund is for situations just like this, where it's do or die. It's not because you want to have pizza and you have no money. That can wait. Emergency is emergency. So creating what we call a family bank, a fund that is growing guaranteed while it sits there for true emergencies. If you don't have that asset to your family, protecting you, protecting your future, setting aside money for your retirement, because if you put an emergency fund in place and that money grows compound interest, and you don't, if God willing, you don't need it because you don't have emergencies that are drawing from the fund, that money is now growing compound interest, is going to provide you with a nice and comfortable retirement. But if you don't put that in place, it's never going to get done, because there's always an emergency that's drawing from that fund that you have easy access to. So having a family plan, having an emergency fund that is non-accessible, you can get it if it's an emergency, but you cannot just zell it from one to the other to have easy access for emotional purchases. That is the type of protection that you want to start setting up if you don't have that yet, because if it is needed, you have to take it, we have somewhere to take it from. If it's not needed, it's going to augment, it's going to benefit your retirement. Okay, so if you don't have that, that's something that you want to think about and talk to your agent about setting one of those aside, or preparing ones, or starting one of those up, because that's where it's going to help you avoid the need to either go in debt or borrow money from family and friends to be able to supply your family needs. And that's exactly where debt comes from, is the lack of preparing for emergencies where you have to borrow because you don't have it at that moment. And a good portion of large debt is that exact situation. A medical emergency came, or a family emergency came, and you were not prepared to draw from your family bank, and now you have to borrow to take care of that emergency, and now you're struggling to pay that back. If you had set that aside and prepared when your a little bit at a time. You don't need a lot, but when you put little bit at a time and you let it grow and compound interest, guaranteed you will have a large fund very soon, because compound interest helps you grow that that fund for you to have it for situations like that. So again, I'm not going to go into the emergency fund family because that was not the topic for today, but that's something that if you're watching this later, or as an agent, you're sharing this with your client, get back to the person that shared this video with you, because you are missing out on an amazing opportunity to prepare yourself for situations that happen all the time. When my clients that had a family bank before COVID were able to be fired and be without a job and be without work for a good portion of COVID without going crazy, without getting worried about income, without having to wait for the government to send them a check for them to supply their personal needs, but because they prepared for such a time. Now, I have clients that had just started before COVID and they didn't have enough on their family bank. They did need to have, they had to wait for government funding or help from their friends and family to be able to support their family throughout that time where a lot of people were not working. So, emergencies are emergencies. We don't know when they're coming. And when you're prepared, you are prepared. When you're not prepared, you have to rely on others or go into debt to be able to supply your needs. And that's what I'm trying to help you. There are many ways to deal with that. And the easiest way to deal with that is to ignore it, pretend it doesn't exist. I'm from Brazil. A lot of people, that. But a lot of Brazilians have a taboo of talking about death. They don't want to talk about death. No, we don't talk about that. That's a taboo. So the frame of mind is, let's not talk about it. And because you don't talk about it, it's not going to happen, right? Because I don't talk about it, I don't think about it, I'm not going to die. No, you're going to die. 100% of us are going to die. So the wise decision is to, although you don't want to be thinking about that, you do want to prepare for that. Biblically, we're called to be good stewards of everything, our gifts and our abilities. We're supposed to be good stewards of the money that we receive. And so biblically speaking, it is an important part of every family, household, every couple, husband and wife, when you talk about money, to prepare for the future, to prepare for the time when you are not going to earn an income. So then you're not a weight on your descendants. And so that's what I'm talking about. So if you are the breadwinner and you're not prepared for a day that you can no longer bring income into your household, this is the video for you. If you are a breadwinner and you're not prepared for retirement or for the years that you will be sick, and it doesn't matter how healthy you are, as you get older, you will need medical help. Doesn't matter how healthy you are. As you get older, your body starts going bad and you're going to need the doctor, you're going to need medication, you're going to need care. And if you don't prepare for that, then your descendants are entrusted with that care and that cost of that care. And so that's where the family bank comes in, that where ensuring your assets comes in. Because again, nobody wants to see you losing your house, your car, your AVs, your boats, whatever. Nobody wants to see you losing that, especially if you have a hardcore diagnosis like that. People feel for you. People want to be helpful to you, but you don't want to depend on people's help in order for you to continue living the lifestyle that you live right now. So again, if you're curious, if you want to know what your numbers look like, what it would cost on a monthly basis, most of these companies offer all kinds of types of payments. You can pay a 1 yearly premium to cover you for the year. It's usually a little bit cheaper, or you can spread it out monthly, or you can do quarterly or semi-annually. Just have to talk to your agent, because it has to be run again by your age, your health, and how much you want to cover. And another thing that I wanted to say to you about is that you don't really just have to stay within your assets. I ran an illustration for a client that wanted to also, he knows that in 3 years, his youngest will graduate from high school and go into college. And he is thinking, okay, I'm going to be spending $50,000 to $60,000 in college in 3 years. So I would like to build in the college amount that I'm preparing to pay into this protection in case I cannot work and pay for college. I still want my child to be able to attend college, and I'll be able to provide that money to that to my son. And so yes, we put in, we calculated based on the degree that this the student, he wants to go into medical. And so they live in Missouri. And so we looked at the schools in the area, and we looked about, it's going to be about 20,000, 17 to $20,000 a year. Right now, I don't know what 3 years is going to look like, but we put in about $60,000 for education. Medical is going to cost a lot more, but we went with the, with the easier amount there. But we're covering that kid when he graduates from high school. If his dad cannot work, he will be able to go to college nonetheless. So it doesn't have to be a physical asset. It has to be the amount that you want covered in case you cannot provide income to your families. If you're the breadwinner, if you're not able to pay the bills, who's going to pay the bills on your behalf? And that's what this product is all about. Okay. So I just wanted to share this information with you guys. If you have any, I'm going to stop recording. So if you want to if you have any questions, or if you want to send me any kind of comments on the share. So I just want to make sure that if you're watching this on YouTube, on the comment section, it has my contact information on my website. You can contact me there. If an agent sent you this video, please contact your agent back, because they'll be able to run illustrations and help you figure out what is the best scenario for you. So thank you for watching.